Should I just get started? I'll do a couple more minutes before the same. I'm going to give it one more minute and then I'll get started. Okay, I am going to get started. Let's click on it. Welcome back. I guess I saw you in San Francisco, but we had masks on, so at least we know what we look like now. So.
And we very unfortunately have to put the masks on again. So they recognized you now. You recognized them.
We all have to put a mask on. I brought my mask down too. So.
Thank you.
Yeah. I thought the mask mandate was done in New York, but I guess it's not inside the classroom in NYU. So, no. So now that I'm masked back on, you can be incognito for the next 2 days. Okay. So the last time we met, we were talking about the theocratic trifecta. Bad things have happened to each of the trifecta, but we won't talk about it. No. Next 2 days, though, we're going to talk about valuation, something of real substance that actually makes a difference. A little bit of history. I came to NYU in 1986. When I came to NYU, I was given a class to teach. It's called Security Analysis. Heard of that class? It's a class with a very long tradition. It was taught in the 1950s at Columbia University by a guy called Ben Graham. Heard of him, right? If you haven't heard of him, you might have heard of his most famous student. Anybody guess who that most famous student was? Warren Buffett. So in 1986, they give me this class to teach. It's been taught for 35 years at different business schools. I take one look at the class and I tell the head of my department, I don't want to teach this class. Not a great attitude for an assistant professor who's just been hired. But he said, why? And I said, it's the most boring class ever. Because by 1986, it was showing its age. It was 4 weeks on stocks and 3 weeks on bonds and 2 weeks on futures and options and 5 weeks on institutional detail. There was an entire session on listing requirements in the New York Stock Exchange. Teaching was so easy in the days before Wikipedia. You could actually come in and spend an entire session listing out things that were in the documents and everybody took everything down. I couldn't try that today. But the guy was he should have fired me, but he said, what would you like to teach instead? I said, I'd like to teach a valuation class. He said, don't do it. There isn't enough stuff in valuation to fill a class. And you know what? He was right. In 1986, there wasn't enough stuff in valuation to fill a class. No. There were no books on valuation other than the security analysis book that Ben Graham wrote. And you know when he wrote it? 1934. First edition, 1934. It's a book that reflects its time. It's a great book, but it's a book born out of the Great Depression. We sometimes forget that the way we think about topics is very much tempered by the times we lived through. So it's a book that thought about buying safety. So that's at the core of security analysis. Not a great valuation book, because if all you want to do is value a phone company over and over, that book works. But if I gave you Zoom or Peloton to value, you're going to throw up your hands and say, this book isn't helping me. But I really, really, really wanted to teach this class. And I discovered very early in my academic life that if you want to get anything done at a university, the best way to do it is to do it subversively. Because if you try to get official permission, you know what would happen, right? A committee would be formed. You guys have experience with committees being formed? They meet and they forget what they're meeting about, but they keep meeting because they're supposed to keep meeting. Then there are baby committees that they call subcommittees and subcommittees. Very incestuous relationship between these committees. And 35 years later, they'd come back to me and say, you're ready to teach your class. I'd be too old to do it. So I said, I'll teach your damn security analysis class. I didn't use the word damn, but that was my feeling when I said it. And I walked in and taught a valuation class. This was 1986. There were no cameras in the classroom. You closed the door. I could be teaching cooking for 15 weeks. And if you give everybody A's, nobody complains. And I taught a valuation class. That was 1986. You know how long it took them to catch on? In 2008, I get a call from the dean's office. And they say, we hear you're teaching a valuation class. I said, yes, I've been doing it for 22 years. They said, we don't see it listed anywhere in the course listings. I said, that's very easy to explain. I've been hijacking all these other classes you've been giving me and teaching valuation instead. For 10 years, they gave me a class called Equity, Instruments, and Markets. I'm not in the least bit interested in instruments. I don't care much about markets. I have only a passing interest in equity, which leaves me with and I taught valuation instead. They said, that's not right. We should call it valuation. I said, I agree. So if you look at the NYU course listing, valuation shows up for the first time in the fall of 2008, just in time for the market crash. So maybe this has something to do with it. In the spring, I just finished teaching 2 valuation classes, one to the MBAs and one to the undergraduates. I teach them both in the amphitheater. I keep begging them to give me a room like this, but I teach in the Paulson Auditorium. So 300 MBAs and 300 undergraduates. And that was my 57th and 58th semester teaching valuation. And I'm going to say something about this class that's going to encapsulate what you're going to hear over the next 2 days. Everything I know about valuation, I've learned in the course of teaching this class. Let me repeat that again. Everything I know about valuation, I've learned in the course of teaching this class. Let me be specific. In October 1987, I was teaching this class for the third time, the third semester that I taught it. We were still downtown. The NYU's Graduate Business School used to be downtown, right next to the American Stock Exchange. My office was on the 9th floor. So I finished teaching my class. I come into my office. It's 10:45 in the morning. I look out of my window, and I can see that everybody from the American Stock Exchange is out on the street, all the traders. They're blocking the road. So what happened? A fire alarm went off. You know what happened on October 19th of 1987? It was Black Monday, but Mondays are always black. It's the worst day of the week. So lots of Black Mondays in our history. What was so black about that Black Monday? The S&P 500 dropped by 22.68% in one day. Visualize what that would look like today, right? A 22% drop in the Dow would be like 8,000 points. We'd all be freaking out, right? And people were freaking out. The reason they were out on the street is trades were not going through. There was too much of a volume of sell orders, not enough buy orders. Cutting a long story short, Wednesday, I'm back in front of my class. Guess what the first question I was asked was? How, with your valuation tools, can you explain a one-day drop of 22.68%, not in one stock, that you can explain away, but in the entire market? I didn't know the answer, but I had to try. And in the process of trying, I had to start thinking about what causes market crises. How do they play out in valuation fundamentals? And that was the start of the process, because we've been tested over and over again with crashes like this, and you got to come up with a way of explaining how markets can drop 5%, 10%, 15% over the course of a day or two. Everything I know about market crises, I started thinking about on October 19th of 1987. And then you get to the 1990s, and you get a new phenomenon for public markets. Let me emphasize that, public markets. In a minute, I'll explain why I said public markets. Young companies with small revenues and big operating losses and unformed business models. You know what I mean by unformed business models? They haven't figured out. It's not that they're not making money. They haven't figured out how to make money yet. We're going public. Now remember, these companies have always been around, but prior to the 1990s, where did they go to get capital? Private equity, in fact, is the more mature version of it, but venture capital. They went to venture capitalists to invest in these companies, and they would invest in 10 of these companies, 3 would make it, they'd exit as public companies. Prior to the 1990s, companies like those did not go public. If you get a chance, go find the Apple prospectus. It's still online. You can download it from 1980. Or the Microsoft prospectus from 1986. Take a look at what those companies looked like when they went public. They were small companies, but they'd figured out how to make money. Their business models had formed. But in the 1990s, for the first time in public markets, you saw these companies going, reaching public markets. Of course, that was the start of the dot-com boom. I remember the day in 1997, a student in my class put up his hand and he said, "Have you heard of this company called Amazon.com?" I said, "I bought a couple of books on their online site last week." At that time, they were an online book retailer. Not an online retailer, online book retailer. He said, "Can we value Amazon.com in class?" And stupidly, I said yes. Why stupidly? Because there was nothing in the literature on how to value a company with small revenues and big operating losses and unformed business model. And we had to figure out our way through. In fact, I still tell people everything I know about valuing young companies, I learned in the process of valuing Amazon in the late 90s. I kept a journal as I valued Amazon to show you how many roadblocks I ran into where there was no answer in the literature. The journal was 75 pages long before I was done. I never waste anything I write, so I slapped a title on it, The Dark Side of Valuation, Can Amazon.com Be Valued? It's still on my website, the original journal. And when you see my valuations of Paytm and Zomato last year, or Airbnb or Palantir the year before, you're going to see what I did in Amazon play out on young companies. Then you get to 2008, and you get a crisis. A crisis created by banks behaving badly. The market melts down. And again, the question comes up in class, why when banks melt down do the rest of us feel the pain? The side costs of risk taken by banks. And again, in class, we had to figure a way of bringing in those side effects into valuation. And then you get to the last decade, and you've got the growth of the numbers company. Let me explain. Take a company like Facebook. What's the most impressive number about Facebook? Is it its revenues? No, lots of companies have far more revenues than Facebook does. Yeah? What did he say?
User base?
It's the fact that they have 3 billion users. Its revenues are pretty ordinary. Its margins are good, but Altria, Philip Morris has higher margins. It's the fact that there are 3 billion people on its platform. That's mind-boggling. Think about it. 1 out of every 2 adults on the face of the earth is in the Facebook ecosystem. That includes Facebook, WhatsApp, Instagram. The most impressive number about Netflix is A, the amount of money it spends on content, mostly useless, but the fact that they have 250 million subscribers. No entertainment company in history has had that much of a subscription base. You're saying, so what? 2017. Again, person in my class puts up almost everything that I've had to learn in the context of somebody asking a question about in class. It says, can you value an Uber rider? I still remember the day. It said, can you value an Uber rider? Not can you value Uber, but can you value a rider to Uber? Let me ask you a question. How would you value an Uber rider? What's the value of a rider to Uber? Hey, how many of you Uber? No. So what's the value of you to Uber? If I were valuing you as a rider, give me the process you'd go through. First, you'd have to estimate how long a rider will stay on, right? So once I get you in my app, will you stay on 10 years, 15 years, 20 years? Then I'll have to figure out how much you will spend on Uber each year. Then I have to take 20% of that and make that my revenues. Why 20%? Because Uber breaks it 80% of the driver, 20% for themselves. Then I have to figure out the costs of servicing a rider. And I'll come up with cash flows every year from having this rider for the next 15 years. You take them, and that's exactly what I did in classes. I went through valuing an Uber rider. It took a couple of weeks to finesse the framework, bringing in the cost. But I'm glad I did it, because once I had the framework, I could value a Netflix subscriber, a Spotify subscriber, an Amazon Prime member, a customer to any company. And then finally, you get to 2020. I was teaching the class, my 2 classes again, the MBA and the undergraduate classes. Classes were going swimmingly well. On March 6th of 2020, NYU sends out a notice saying, go home, a week before spring break. And they said, we'll be back in about 3 or 4 weeks, complete and total lie. But we went home and we stayed home. In fact, I taught the rest of the semester from my home in San Diego, so I'm not complaining. I was 2 blocks from the beach, at least I was watching the ocean every day. But we had an experiment that the global economy had never gone through. An experiment where we're going to shut the entire global economy down and see whether we'd ever be able to wake it up again. Nobody knew. I mean, in hindsight, we're saying it was obvious we're going to come back. But nobody really knew what would happen when it was like turning off this giant engine that had never been turned off before, and hoping and praying that when you put the key back in, 2 months later and try to turn it on and come back on again. But it shut the entire global economy down. March 23rd of 2020, which is almost the absolute floor of that collapse that happened in those 6 weeks when COVID first hit. I had to, class was back in session, and somebody said, can we value Boeing? Everybody's talking about the fact that it might not make it through next month. There's a very real, there's talk that none of the airlines would make it, Boeing would not make it. And actually, I valued Boeing in class. I made a YouTube video. It's still up on valuing Boeing when nobody's buying aircraft. But again, we had no template to go back to, nothing we could look at and say, hey, this has happened before, let's go back and look at it. And of course now we're seeing a phenomenon that at least in the US and Europe we haven't seen in 40 years, which is the return of inflation. Let's face it, most US and European analysts are spoiled and they become sloppy. Why? Because inflation is low and stable, you don't think about it. In fact, I talk to equity research analysts and ask them, how do you incorporate inflation into your valuation? You know what their answer is? I don't even know. Because we tend to think in nominal terms, we put in a discount rate. Nobody explicitly thinks about inflation until it becomes high and unstable. Latin America, everybody thinks about inflation all the time, right? It's not as if it's in the back of your mind, it's in the front of your mind, around your mind, in your mind. In fact, it's a very unhealthy place to be when everything is driven by inflation. But this year again, people are trying to figure out how do we explicitly factor in not only that inflation is back, but it could be different in the future. Every crisis is an opportunity to go back and revisit things you thought you knew and do them better. So what I hope to do over the next 2 days is take what I've learned over 36 years of teaching, talking, thinking about valuation, and summarize it in 2 days. And it's really not that difficult to do. And the title kind of gives away why. This isn't rocket science. If you can add, subtract, multiply, and divide, you have all the mathematical skills you need to do valuation. If you have trouble with those, then I think we have a different issue. I can't really help you. But you have a calculator anyway, so even if you can't do it, your calculator will do it. It's not complicated. We have practitioners who make it look complicated, and we'll talk about why, because it's in their best interest to make it look like this mysterious, difficult thing to do. We're going to strip the mystery and go back to basics, because once you get the basics, you can put in the mystery if you want it, but you can abandon it if you don't. So by the end of tomorrow's session, you will know as much about valuation mechanics as I do. But your work is just going to get started, because you learn valuation by doing. And I'm going to come back and emphasize this over and over again. You learn valuation by doing, not by reading about it, not by watching other people do it, not by listening to podcasts on valuation. For God's sakes, don't listen to podcasts on valuation. It'll be incredibly dry. But by doing it. So the way I'm going to structure this session is I'm going to spend the first half of this morning session doing something that many of you will view as kind of a tangent. You say, why is he wasting his time? Laying a philosophical foundation for what valuation is, why we do it, and how different people can disagree about it. I'm going to argue that this first hour and a half is the most critical part of this class, because this is what's going to allow you to kind of think about the numbers and say, why are these numbers different when different people use them? Then the second half of the morning session, we're going to start on intrinsic valuation. Sounds fancy, right? But in intrinsic valuation, you value something based on it as a business. You're saying, as opposed to what we'll talk about how different people put the numbers on companies, most people don't put numbers on companies based on its capacity to generate cash flows as a business, but on other things. We're going to do intrinsic valuation pretty much for the rest of today. We're going to talk, and in the process, we have to get our hands dirty. You cannot skate on the outside in valuation, say, I want to do valuation, but I don't like to deal with numbers. You have to learn to get your hands dirty. So we're going to talk about discount rates and cash flows and growth rates. But we're going to weave them through a big picture so you can see how they all fit together. Tomorrow when we start, we're going to start on what I call the dark side of valuation. Sounds mysterious and scary, like a horror movie. But let me put it this way. If all you have to do is value nice money-making companies with a lot of history, you don't need this class. In fact, I don't need you. I could probably automate the process. Actually, I have. If you have an Apple device, go to the App Store and type in the word you value. Lowercase u value as one word. I have apps for the iPhone and the iPad, which are basically intrinsic valuation apps. You download the app, I'll ask you for 12 numbers on a company, I'll churn out a valuation for you, which I will put up against any banker that you will pay. I don't know how much to do the same valuation. For a nice mature company, it's easy, it's a slam dunk. The dark side of valuation is about valuing difficult to value companies. Like what? Young companies, startups, distressed companies, commodity companies, financial service companies which have regulatory capital problems. Already you can see these are not the exceptions, these are the rule. Almost every company has layers to it that makes it complicated and difficult. We're going to talk about valuing companies when things get difficult. As opposed to what? As opposed to what most people do when things get difficult. They abandon valuation and they price companies. I'm going to draw a contrast between valuing and pricing companies and talk about why they can give you different answers. And then tomorrow evening, tomorrow afternoon, I'm going to come back and finish the pricing part. How do you put a pricing on a company? So we've got a lot on our plate. I'm going to start with a very simple question that I get asked all the time because I've taught this class for a long time. Why do I do valuation? What's the point? Because let's face it, most people don't believe in valuation. Most people do valuation because it's a job. They do it to cover their rear end. And I don't include most bankers and equity research analysts. They have no faith in their own numbers, but they can churn out what looks like a valuation. So I'm going to start with there you are. With why I do valuation. I do valuation to fight the lemming in me. You heard of lemmings? Lemmings became famous or infamous in the 1950s when National Geographic filmed a most amazing sight. Thousands of big, ugly, rat-like creatures gathered together on a cliff, ran right off the cliff into an ocean to commit collective suicide. And ever since, one of those big questions has been, why did they do it? I don't know the answer to the question. I've heard it's a Disney conspiracy that they got these creatures together on a cliff and drove them off the cliff. No. I don't know the answer. But let's do some virtual imagery. You could see why the first lemming did it, right? He was going too fast. He couldn't stop. He went off the cliff into the ocean. Incidentally, these guys can't swim. It kind of seals the deal. He's dead. Second lemming, too close to the first guy, also dead. I'd like to visualize yourself as the very last lemming in that group. You're running as fast as you can towards a cliff. You've seen your entire tribe disappear off that cliff. I would assume you have second thoughts about what you were just planning to do, right? Your left brain, your right brain, whatever part's rational, saying, stop, stop, stop. But then you hear this voice in the back of your head. You know what it says? They must know something that you don't. Remember those 7 words, the 7 most deadly words in investing and valuation. They must know something that I don't. I hear it all the time when I value companies. I remember valuing Tesla last January at $600 per share. Stock then was trading at $1,200. Now, if I just stop there, $600 per share is less than $1,200. My rational side saying, don't buy that stock, right? Then I hear this voice in the back of my head. They must know something that you don't. Speaks in a monotone. Don't ask me why. And when you hear that voice, magical things will start to happen to your valuation. Your growth rates will start to get higher, your discount rates will start to get lower, your cash flows will start to get bigger. It's almost like your Excel spreadsheet has taken on a mind of its own. And the 600 will move to 800, to 900, to 1100, and before you know it, you're at 1200 with everybody else. In fact, I divide the whole world of investors into 3 groups of lemmings. The first group I call proud lemmings. I'm a lemming and I'm proud to be a lemming. They call themselves momentum investors, but it's pretty much the same thing, right? Because what do? What do momentum investors do? They look for a crowd and they join in. You're buying, I'm buying too. You're selling, I'm selling too. Proud lemmings. I can't pull off being a proud lemming. The second group of lemmings I call Yogi Bear lemmings. Remember, Yogi Bear is a cartoon bear. He was smarter than the average bear. Yogi Bear lemmings think they're smarter than the average lemming. They want to run with the crowd to the very edge of the cliff and sell Bitcoin at 60,000 before it goes to 20,000. Great if you can pull it off, right? You get all the upside and none of the... Admit it, you're tempted. You're saying, there are a lot of stupid people out there. I'm smarter than the average investor. I'll get out before the cliff hits. I wish I could. I have no idea what the cliff is. I can't pull off being a Yogi Bear lemming. So I'm not a proud lemming and not a Yogi Bear lemming. That's me. Lemming with a life vest. That's all I aspire to be. That's what valuation gives me. It gives me a life vest. Because let's face it, as human beings, you're going to feel the urge to join the crowd. Don't tell me you're rational, because a rational human being is an oxymoron. Because what you have built into you has been built in through evolution. Why do you think you panic when everybody else is selling? You think you're the first person to panic? Because that cave person who did not panic when he saw his entire tribe running towards him would have been stopped by a mammoth. There is a price to being a contrarian here. So when you see everybody selling, guess what you feel the urge to do? You want to get out of the market now. When you see everybody buying, you want to be part of the crowd as well. What valuation does is it slows the process down for me. It says, wait, I know you want to buy. Everybody's buying Zoom right now. But let's look at the numbers. Let's look at the cash flows. And 9 times out of 10, I'm going to do whatever I wanted to do in the first place. Maybe that 1 time out of 10 when I slow the process down, I let good sense win. I do valuation not because it's going to stop me from doing stupid things. It'll slow the process down so I don't do the stupid things right away. Maybe I'll wait a day or 2 or 3 before I do it. And that's a win in my book. So what I'd like to do is I'm going to start off by laying out a few themes that are going to drive through the next 2 days. I'm often asked the question, is valuation an art or a science? Let's break that question down. Is valuation a science? Well, let me make it simpler. Is mathematics a science? It's the only pure science. In fact, mathematicians are convinced that the rest of us are imposters. And think about it. Think about what it is about mathematics that makes it a science. Anybody want to give that a shot? What is it about mathematics that makes it a science?
The base rules?
I'm sorry?
Base rules?
Oh, we have lots of base rules in finance and psychology. None of them work, but we have rules after rules. Think of accounting rules, right? All screwed up. It's not just base rules, but it's absolutes. You know what I mean by absolutes? 3 plus 2 is, humor me. 5 when I count on my right hand, 5 when I count on my left hand, 5 if I go to the North Pole and count 5. 3 plus 2 is 5. It's not might be 5, it could be 5, maybe 5, it's 5. And if you get any answer other than 5, you are wrong. There's a right and a wrong answer. You get the inputs right, you get the output right. If you get the inputs wrong, you get the output wrong. Or conversely, if you got the output wrong, you must have done something wrong. Is there any chance of valuation being a science if I use that definition? Or put differently, let's say you sit down to value a company, you have every tool that's out there. You have every piece of data on the company. Let's pick the company. Okay? Let's make it Netflix right now in the heart of this adjustment process going on of going from maybe high growth to low growth. Let's say you collect every piece of information you can on Netflix. You have access to every tool that's out there. And you bring them all to play to value Netflix as of right now. What percentage of the time are you going to be wrong?
Always, it won't be precisely right.
And why?
There's just too many variables.
No, there's a simpler answer. You're not God. Right? Let's face it, there are people who walk around, especially in Wall Street, with a God complex. But the reality is, none of us can foresee the future. You can do everything right and be horribly wrong, and it's really not your fault. Can you imagine valuing Marriott in late 2019? Hotel company, right? It's been around a long time. You project the cash flows out. And then what happened? This damn virus comes out of nowhere and shuts you down for a year. You think, so if I come to you and say, why didn't you think of COVID when you did the valuation in 2019? If you were thinking of COVID, I have far bigger suspicions about what you were up to. But the reality is there are lots of, it's almost everything is out of your control. You can do everything right and be horribly wrong because uncertainty is endemic. I'm going to use a phrase that I will use over and over again on different items. Uncertainty is a feature, it's not a bug here. You can't make it go away. Valuation cannot be a science, and the sooner we accept that realization, the healthier the discussion becomes. The reason I say this is there are, a few years ago, the Indian government decided to put in these requirements that to be an appraiser in India, you had to have a certification, which basically is a make money for a lot of different people scheme. So they asked me whether I'd be willing to help them on the certification. And I said, what's the end game? He said, we want to make valuation a science. And I said, count me out. Because this is what got accounting valuation into trouble in the first place. They thought if they wrote enough rules, there'd be mathematics. There's a zero chance of that happening. Valuation is not and will never be a science. Valuation is not, and people then say, if it's not a science, it must be an art. The essence of an art is you can do whatever you want and get away with it. And the essence of an art is great artists are born, they're not taught. Valuation is not a science, it's not an art, it is a craft. In fact, the discipline I think comes closest to valuation is cooking. Think of how you master cooking. You could read cookbooks from now through eternity. I watched a Julia show on Netflix. Or is it HBO?
Hulu.
Hulu, there you go. There's eight episodes on Julia Child. You know what? I couldn't whip eggs to have this thing, the white standing up I could try for the rest of eternity. Just watching the show, I'm not going to get it. You don't learn cooking by reading cookbooks. You don't learn cooking by watching cooking shows. You learn cooking by cooking. And the first time you cook, what happens? Fire alarms go off. You're going to order out that night, I guarantee that. But you will learn some things about cooking that will stand you in good stead. You learn valuation by doing. Now, in my regular valuation class, because it's stretched out over 15 weeks, I have a luxury. First week, I come and talk about philosophy. And then at the end of the week, I put up a valuation of the week. Week 1 of the class, where I pick a company to value. Spring of 2022, the first company I valued was Tesla. Why? Because it's exciting. People want to do it. So I value the company, I put up my spreadsheet, I put up my story for the company. I'm going to talk a little bit about what I mean by the story for the company, because every valuation you're telling a story. Then I invite everybody in my 2 classes, undergraduate and MBA, to value the company. You know what the reaction is? It's week 1 of the class. We don't know how to do valuation. I said, that's okay, give it your best shot. So you know what they do in week 1? They go into my valuation, they change the third decimal point on the risk-free rate, leave everything else unchanged, and guess what they find? They get a value exactly like mine. They come and say, I got a value just like yours, I just let it go. In fact, the following Monday, when they turn, it's in a Google shared spreadsheet, they turn in their valuations, I do a histogram of what they found. And guess what it looks like? This huge column right on top of my valuation. Everybody agrees with me. Week 2, I pick a different company, as different as I can get. I think one year I picked PZ Cousins, Nigeria. You're saying, why do you go there? To get as different from Tesla as I could. You've got an emerging market company, an appliance company in Nigeria, and I value the company, I tell a story, I invite them to do it again. And week 3, I might pick JP Morgan. Week 4, I might pick Severstal, the Russian steel company. And each week they do this, and here's what starts to happen. As they get more comfortable with the material, they start to disagree with me more. The distribution starts to spread out. And I know the class is working when in week 7 somebody comes up and says, that valuation you did of whatever company, I think you were wrong on every single input. And I said, that's good. The class is working. You learn valuation by doing. And the more diverse the companies you pick to value, the more you will learn. Every time I value a company, and this is 40 years into the process, I still find things that I learned when I value an individual company. I say, I didn't know that. When I valued Aramco in 2019, I learned things about valuation. I thought about things in valuation I hadn't thought about in other companies. When I valued Paytm, an Indian payment processing company last year, I learned things about valuation I hadn't thought about until then. If this valuation is a craft, there's also a follow. You will never master it. I mean, I remember watching This Old House on PBS. I mean, I give away my age of this. And there was a guy who was a master carpenter on that, called Norm whatever, I forget his last, maybe he didn't even have a last name. He was a master carpenter, and he used to say, well, every time I look at somebody else's work, I learn something about carpentry. Every time I do something new, I learn something. That's the nature of a craft, is you never quite master it. And I have to remind myself of that, because when I get too comfortable saying, I think I've got this, is when markets decide to surprise me with something that says, you really don't have this. So think of the next 2 days as the start of the process of learning valuation. If you really want to master valuation, your work starts when the class is done. When you pick a company to value and you decide to value, pick another company to value it again. Every time you value companies, your understanding of valuation will increase. And don't say, I don't know how to do it. Nobody does. Just work it through, and each time, even if you get stuck, you will learn in the process of doing valuation. Here's my second thing. Talked about 2 words in investing and valuation that are used interchangeably that should not be. The 2 words are value and price. We know what drives the value of business. We've known for hundreds of years that Venetian glassmaker who bought a business in the 1400s or 1500s knew what drove value. It's driven by cash flows, cash in, cash out. In fact, you could argue that accounting earnings has distracted us from that reality. Second, it's driven by the risk in those cash flows. You'd much rather have those cash flows be stable. And third, it's driven by growth. You'd prefer to have growth. So cash flows, growth, and risk would have driven value for as long as we've estimated value. Of course, in the last century, we've created discounted cash flow models that bring them all together. But we didn't invent value. It's just a construct we use to bring cash flows, growth, and risk into value. So we know what drives value. You know what drives price? Demand and supply. You think, aren't demand and supply driven by cash flows, growth, and risk? Partially. But they're also driven by things like mood and momentum. Think of how much momentum has shifted on Bitcoin between a year and a half ago and now. Think of how much momentum has shifted on Peloton and Zoom between 2020 and 2021, and then from 2021 back to 2022. and revenge. You think revenge? Remember the GameStop episode about a year and a half ago? Where a bunch of traders on Reddit created this huge run on GameStop where they drove the stock from $20 per share to $400 per share. So when that happened, I was bemused because I know what the GameStop business model looks like, and it doesn't look great, right? Who goes into malls, into stores to buy games anymore? But I was curious. Maybe they saw a new business model where it go online, become an online gaming platform. So I was curious about why these people were pushing the price up from $20 to $400 per share. So I went on the site, Wall Street Bets, and I started checking out the comments on what these people were thinking as they were pushing the price up. You know what the primary driver for these people buying shares in GameStop was? What were they trying to accomplish, first and foremost? No, making money was very much at the bottom of the list. They do things like misspell hold and think this is some advanced intellectual enlightenment they've reached. Making money was not there, business models were not there, it was revenge. Against whom? The hedge funds. It was all about, we're going to teach the hedge funds a lesson, even if it means we go bankrupt in the process. No. You think that doesn't make sense? It actually makes complete sense. As human beings, guess what? Revenge and mood overwhelm rationality every single time. You scratch your neighbor's car, even though you know she has cameras all over and she's watching you because you hate your neighbor. You're going to go to jail, but I've scratched a new BMW. I feel really good about this right now. People often trade. Trading is driven by emotions. In fact, there's a whole area of finance dedicated to recognizing why pricing and value can be different. It's called behavioral finance. Behavioral finance doesn't affect value, it affects it determines why prices can be different from value. You're saying, what's the big deal? We know what drives value, cash flows, growth, and risk. But if you have to price something, you know how you price it? You look at what other people are paying for similar things. I don't know how many of you own a house or an apartment, but if you bought a house or an apartment, think of how you came up with a number to pay. You looked at what other people were paying for similar things. That's what pricing is. It's about looking at comparable companies and what people are paying for it. 90% of what passes for valuation out there is pricing. What investment banks call valuation is really pricing. When somebody uses 8 times EBITDA, they should never be using the word value for what they did. They're pricing something. When somebody asks me, can you value my company? The first thing I say is, I don't do valuation for a living. You should go talk to KPMG or Deloitte or somebody else. But I also ask them a question. Do you really want me to value your company or price your company? And if you dig a little deeper, it turns out that most of the time when people say, I want to value something, they really want to price something. So I'm going to draw that contrast. As I said, the first day and a half of this class, I'm going to spend on valuation. Cash flows, growth, and risk. But towards the end of tomorrow, we're going to talk about how do you price things better. And you're going to very quickly see me switch gears, because that's really nothing to do with finance. It's got to do with statistics. It's got to do with the data we have and how to use it better. Salim?
Thank you, Professor. Just wanted to check on the pricing discussion. Where does negotiation and liquidity conditions in the market sort of influence pricing? Because I'm thinking, if I'm selling it...
Yeah, if you're in a strong bargaining position, you get it, and you're buying something, you're going to negotiate for a lower price, right? Yes. The bigger question is, where does value... Because all pricing is negotiation, right? How does doing valuation, if you really believe as an investor, if you believe in valuation, how does valuation help you in that negotiation?
It would guide where I want to place my
or where you get up and leave the table, right? If you don't have a value focus, what's going to happen? You're going to negotiate until you get the deal done, even if it's a terrible deal. And guess what? Most M&A deals are negotiated prices. Value is not even part of the discussion. because people are so intent in thinking about, if I get the deal done, I won. That's a terrible end game. But you can see what happens if value doesn't even enter the discussion. So pricing is all about, but that's why I said it's demand and supply. If you're the only game in town, you're going to be able to negotiate a better price for yourself. Is pricing driven? Absolutely. Liquidity is very much a factor in pricing. It could also affect value through, when you talk about cash flows, growth, and risk, because it could affect when you exit. You've got to factor that in thinking about value. But liquidity is more a pricing factor than a valuation factor. Third theme, valuation. I describe valuation as a craft where you learn things as you go along. And when I first started teaching valuation, I taught it like a number cruncher. Let me back up. And I might have asked this question earlier when we talked to February, but I'm going to ask that question again. How many of you, if I asked you to describe yourself, would describe yourself as more naturally number crunchers rather than storytellers? How many of you are more naturally number crunchers? But surprisingly few, maybe not. No. How many of you are more naturally storytellers? And the rest of you are kind of in the middle, or you're neither, or hopefully you're some both, But each of us has a part we're more comfortable with. More comfortable with numbers, more comfortable with story. And we pick, our educational paths based on that. If you're a number cruncher, you become an accountant, an actuary, an engineer, a mathematician. If you're a storyteller, you become history major, literature major, psychology major. And then if you're a number cruncher, you get a number crunching job. Some of us are mismatched. This can happen, and you could be 50 years old. I wish I'd been a storyteller. Yeah? But you get a number crunching job. And we tend to hang out with people who think just like we do, especially as we get older, right? You get in the job, you're a number cruncher, you hang out with other number crunchers. And you start to get the delusions that number crunchers share. What are those delusions? The first is the delusion of precision. Number crunchers, when in doubt, you know what they do? They add decimals. It makes them feel more comfortable. Number crunchers also tend to think they're in control if they can put a number on something. If I can get a number on that, I'm going to be in control. And if you're a storyteller, storytellers have their own delusions as well. They just spin bigger and bigger and bigger stories, and after a while you cross the line into fantasy land. But nobody stops you. You're like creative novelists. You're creating characters who wander on and wander off. You're running a business. You've forgotten you're running a business. I hate to sit in on strategy meetings. The level of bullshit rises to a point where I say, okay, you know what? We've reached the point of exit here, but we'll keep talking because we want to add layers and layers of storytelling. We live in a world where we're thrown in with people who think like we do, who read the same books, think the same way we do. And I learned about 4 years into teaching valuation, it wasn't working for me. What wasn't working? I could value just about any company. I had the tools, the techniques, the metrics, but I had no faith. Strange word to use in the context of a valuation class. Next page, I'm going to talk a little bit about faith, but basically I couldn't act on my valuations because I knew how easily I could move the numbers around. It's really difficult to teach a class in valuation if you really have no faith in valuation. So I took a semester off. It was an excuse for doing nothing anyway. And I thought about, what am I missing here? Why do I have no faith? And the answer was, I just have a collection of numbers on a spreadsheet. Something needs to tie them together. And that's when I came to a realization that it's taken me a long time to get my hands around, which is a good valuation is never just about numbers. A good valuation is never just about a story about a business. A good valuation is a bridge between stories and numbers. What are you talking about? So I showed you my valuation of Tesla from January 2021. You can go look it up if you want. And you look at my revenues in year 10. You know what you're going to see as revenues in year 10? About $450 billion. Already that should give you pause. Why? What are the two largest automobile companies in the world right now? Volkswagen and Toyota. You know what the revenues are? Less than 300 billion. I'm giving Tesla $450 billion in revenues. So when you point to my revenues, say, why are revenues 450 billion in year 10? You know what the answer you don't want to hear is. I use 50% growth for the next 5 years and 30% thereafter. What does that tell you? I mean, that's completely useless. I need to tell you my story of Tesla as a company that's going to allow it to have 450 billion in revenues. What kind of story would that be? A story where most of us buy electric cars. That's got to be the first part of the story, right? Because if only 20% of the cars that are sold are electric, you can never get to 450 billion. Second, in that story, Tesla's got to be the dominant company in the electric car market, which is going to take a little bit of reconciliation because Tesla doesn't sell $20,000, $15,000 cars, and a big chunk of the market is still mass market automobiles. But I need to tell you my story of Tesla. This is what I think Tesla can do that will allow it to have 450 billion. I gave it margins of 16%. Again, that should give you pause. Why? Because the median margin for an automobile company in 2020 was about 8%. I'm giving it twice the margin. So why are my margins 16%? I need to tell you my story of Tesla that will allow it to have higher margins than a typical automobile company. What could that story include? It could include the fact that electric cars are more electronics than automobiles, that the battery is the biggest part of the cost, and that if they can figure out a way to get economies on scale on that, their margins can be much higher than a typical automobile company. Or that Tesla sells software that goes with its cars. You know that Tesla, if you buy a Tesla, the Tesla autopilot or a big chunk of the extra factors are software driven. If you buy a Tesla, the software comes with the Tesla. Right now, upgrading that software might cost you nothing, but what if one day Tesla decides that when you buy a Tesla, every year you've got to pay $500 extra to get the upgraded software, to get most recent features? You think, why does it matter? Software companies have margins of 40%. If there is a segment of Tesla's business that's a software business with a 40% margin, it's going to allow them to earn higher margins than a typical automobile company. My point is every number in my story, when you point to it and say, why is that number what it is? I should be able to back it up with a story. Conversely, every story that I tell you about a company should show up in a number. Like what? I could talk about a company's great brand name, its amazing management, its superior technology, the fact that the government is its ally when it goes out to get higher market share. All stories, but each of those stories has a number in the valuation that goes with it. You think, what if I have a story that I cannot convert to a number? I would view that as a challenge. You come up with a story, make it as qualitative as you want. My job in valuation is to find a number that goes with it. Valuation is about connecting stories to numbers, which means if you're a natural number cruncher, here's what I hope you will get out of the class. I hope you will find yourself free enough to let loose your imagination, to be willing to tell stories. I mean, I've heard the word subjective used almost like a curse when I talk to engineers, but that's so subjective. Life is subjective. Life is not objective. Life is not a collection of probabilities and statistics. It is subjective. There's nothing, it's not a sign of weakness to tell a story, but it takes a little letting go of if you're a natural number cruncher. Be an imaginative number cruncher. And if you're a storyteller, I hope at the end of this class you get comfortable enough with numbers that you know the difference in an operating margin and a net margin and why revenue growth matters and what a cost to capital is trying to measure. That you become a disciplined storyteller, that you know when to stop. You've reached the line of fantasy land. You say, this is where I stop. Disciplined storytellers, imaginative number crunchers. Guess who I have more trouble with every single time I teach this class? Getting storytellers to develop discipline and number crunchers to let loose their imagination. It's not even close. Every single time I've taught this class, I have more trouble with number crunchers than I do with storytellers. You give me 100 history majors, I can teach them enough valuation to be able to value companies tomorrow. You give me 100 engineers, I'm screwed. I'm screwed because everything they look at, they've got to put through those lenses of, is that perfect? Am I getting it right? That's a terrible question to ask in valuation because the answer always is what? No, you're wrong. No, it's not depends, you're wrong. You're going to be wrong. Why? Because in hindsight, everything is going to be wrong. So if your definition is, if I get it right, the actual outcome is going to match it, that's never going to happen in valuation, ever. Which brings me to my final theme in valuation. So one of the things I'm going to do tomorrow is I'm going to take you through the process of how I taught myself storytelling. Because it wasn't easy for me. First time I tried, it was like pulling teeth. I'll take you through a 5-step process that works for me to bring in the storytelling side because I have to force myself to do it. Because otherwise I'm going to open up a spreadsheet and start entering numbers. That's what a natural number crunching reaction is going to be. Which brings me to my fourth and final theme that I'm going to return to over and over again. I don't do valuation for a living. I don't do valuation consulting work. I've never been paid to do valuation. I don't do expert witness work. Which says, why are you doing valuation then? I do valuation because I want to act on my valuations. You know what I mean by act on my valuations? If I value Peloton today at $25 and it's trading at 11, I need to go and buy Peloton shares. You're saying, what's the big deal? You know what the big deal is? To act on your valuations, you first have to have faith in your valuation. I mean, you can value a company, you can get a number on a spreadsheet, but it's a number on a spreadsheet. You have to have faith. Second, you have to have faith that the market will correct your valuation. You know why I use the word faith, right? What's the essence of faith? If you ask me for proof that my valuation is going to make me money, I can't give you proof. If you ask me for proof that the market will correct, I can't give you proof. Which means you've got to kind of have that faith, but faith is fickle, right? Which is you can have faith and the faith is going to get tested. In what way? Let's say I buy Peloton today. It's $11, I valued it at $25. I open the paper tomorrow and it's down to $7. You know what the market is doing, right? It's knocking on your door and saying, do you still have faith? How about right now?
Never been explained that to me.
Yeah. Because it's difficult to hold on to faith. Most investment managers have no faith. They have no faith in value. And I include most value investors. They have no faith in value. They can talk the value game, but they can't walk the value game. I can't teach faith. I can talk about why I continue to have faith. I can talk about how my faith gets tested. And I'll be open about the fact there are times when I bought a stock where I said, you know what, maybe this whole thing is about value doesn't really even make sense. Maybe the market doesn't even care. So those themes are going to run through. So let's talk a little bit about, about what drives this process. So we're going to, as I said, the next day and a half, we're going to talk about intrinsic valuation. Often when I value companies and people disagree with me, which is almost all the time. One of the things that I get accused of is being an academic and a theorist. And the reality is there's very little theory here. This is about, this is about practice. So we're going to talk about the practice of valuation. And before we do that, I want to get rid of some misconceptions about valuation that are widely held, even among people who do valuation for a living. Here's the first one. Evaluation is an objective search for the truth, that you're some kind of scientist trying to put a number on a company. And you know what feeds into this? We sit in front of computers, we enter numbers, and we all convince ourselves we're being objective, we're just being scientific. Let go of the delusion. All valuations are biased. Why? Because when you sit down to value a company, you bring in your preconceptions about that company into the valuation. I mean, I valued Microsoft every year since 1986. And every time I valued Microsoft from 1986 through 2014, I'll talk about what happened in 2014, I found it to be overvalued. Every single time. Now, I could give you access to every single valuation I did of Microsoft. You could dig through the numbers looking for clues, but you're looking in the wrong place. If you get a chance, you go to the 9th floor, my office is open, 969, you walk in, here's what you're going to see. You're going to see my MacBook Pro to the left. You're going to see my Apple iPhone, my iPad sitting to the right. I've got an Apple display. I've been an Apple user since 1981. To me, Microsoft has always been the Darth Vader of technology. And let me use, for those of you Star Wars fans, let me be very specific. I'm not talking Anakin Skywalker, Darth Vader, episodes 1, 2, 3. I'm talking Darth Vader. The Darth Vader on the dark side. To me, Bill Gates is Darth Vader on the dark side. And for the longest time, whenever I sat down to value Microsoft, those thoughts would come bubbling up to the surface. In valuation, you constantly come to forks in the road. Low growth or high growth? Who'd buy this rotten product? Low growth. Low risk or high risk? One virus away from blowing up, high risk. With my biases, I was incapable of valuing Microsoft fairly. I hated the company too much. You know, the other company I was incapable of valuing for the exact opposite reason. I've given you the clue. It's Apple, because I love the company too much. In fact, I've been valuing Apple on my blog now for a decade. If you get a chance, go and look at my very first blog post on valuing Apple. I spent half the post telling people not to trust me. I said, don't trust me. I love this company too much. You think, why would you do that? That's all you can do. When you have biases, all you can do, you can't make biases go away, is be open about them. All valuations are biased because you almost never value a company with a blank slate. Here's my second proposition. You tell me who pays you to do a valuation and how much you get paid. I'll tell you which direction the bias is and how much the bias is. I'll tell you a story to illustrate this. A company called Lynn Cable, about 30 years ago. AT&T owned 49% of Lynn Cable. And they had an option to buy the remaining 51% an appraised value. So the time for the option to be exercised comes about. AT&T goes out and hires Morgan Stanley. So this part of the class is going to be Morgan Stanley. You work for AT&T. You're going to value Lynn Cable so AT&T can buy the 51%. Lynn Cable went out and hired Lehman Brothers. So I'm sorry to do this to you, but think of yourselves as pre-bankrupt Lehman Brothers. And you're advising the seller, Lynn Cable, so they can sell the 51%. So Morgan Stanley works for the buyer, Lehman Brothers works for the seller, looking at the same company. They came back with two very different numbers. One came back with $105 per share. The other came back with $155 per share. I want you to guess which side came up with which number. Who do you think came back with $105 per share? And why? Because you worked for the buyer. You did your job. Lehman worked for the seller. In fact, the difference was so large, they decided to call in a third investment banker. Why settle for 2 fees when you can have 3, I guess? And they called this outfit called Wasserstein Perella. Have you Wasserstein Perella? You're trapped in the middle. I'm going to say something incredibly harsh about these guys, but I mean every word of it. These guys couldn't value $20 in a brown paper bag if you put it in front of them. But if you're Wasserstein Perella, you're trapped in the middle, right? You don't want to piss off either side too much. 105, 155. What's the safest place for you to be? 130, right? They came back with $127.50. I'm going to let you in on a little secret in valuation. If you're asked to value something, never ever come back with a nice round number. Don't tell me the target price is $40. Tell me it's $38.87. It's amazing what that second decimal will do in terms of creating an illusion that they actually know more. People stop asking questions. Exactly, the second decimal point nailed down. When in doubt, add decimals. Trust me. Not only will it make you feel better, it'll also put any questioning away, because nobody's going to ask a guy questions when he's got 6 decimals on his value number. My point is that in valuation, most of the time, the value gets set first, the valuation follows. People decide how much to pay, then they look for justification. When I talked about M&A, I don't even know why people waste their time valuing companies in M&A. You know what the value of a target company is? It's whatever you decided to pay plus $10. I'll get there eventually. But there's a reason M&A valuations are so screwed up. You play the role of an M&A banker. I'm going to come to you for some advice. I found a target company. I'd like to buy it and ask you, do you think it's a good deal? Give me the 2 possible answers you can give me. You can say yes or no. Let's play it through. If you say no, you're paying too much, it's a bad deal, how much do you make as an M&A banker? You earn the undying gratitude of my shareholders, but try paying bonuses with that. So you basically make nothing. And if the deal goes through, you make $100 million. Do you think you might be a wee bit biased in your answer? The more bias there is in the process, the less point there is to actually working out the numbers. You've already made up your mind. And this is just affirmation or covering your rear end. The biggest enemy of valuation is not knowing, it's not cost of capital, not getting the cash flows right, it's bias. There's an amount of bias that you can't take out of the process, but for God's sakes, don't add to that bias. Second big misconception of valuation, and we talked a little bit about this when we talked about valuation not being a science, that if you do a good valuation, you will get the right answer. Or conversely, if you got the wrong answer, you must have done something wrong. Being wrong in valuation is part of life, because you're going to be uncertain about the future, you're going to make mistakes. But here's a follow-up to that I think might surprise you. Not all companies create equal amounts of uncertainty, right? I'll go back about 3 years, 2019, April of 2019, I don't know which week it was, but 2 high-profile companies went public in the same week. One was a company called Lyft. Lyft actually went to the market ahead of Uber. And the other was a company called Levi Strauss. Levi Strauss had been around since the 1800s. It had gone public in the 1900s, gone back private, went back public again. Levi Strauss and Lyft. Let me ask you the first question. Which of these 2 companies, if I asked you to value the 2 companies, which of these 2 companies do you think you can value more precisely? Yeah, because it's long history, the business model is set, you know how it makes money. Lyft, ride-sharing company, nobody in that business has figured out how to make money. Right? DD loses money, Grab loses money, Ola loses money, Uber loses money, Lyft loses money. So if I ask you to judge valuations based on precision, this is a slam dunk, right? Levi Strauss valuation is always going to be better than a Lyft valuation. But if I ask you a follow-up question, which of these 2 companies is the payoff to doing valuation greater? How do you make money on valuations? Markets make mistakes, right? So think of what made Levi Strauss easy for you to value. Long history, established business model. Guess what? Everybody else has exactly those same advantages, so everybody else will be valuing Levi Strauss just as precisely as you are. In contrast with Lyft, people give up. They say, too much uncertainty, I'm not even going to try. The payoff to doing valuation is greatest when uncertainty is greatest. The payoff to doing valuation is greatest with young companies rather than mature companies. The payoff to doing valuation is greatest when markets are in crisis than when markets are stable. In my regular valuation class, everybody's got to pick a company to value. And I strongly encourage you to think of a company to value for this class. But I want you to pick your own company, because I don't want you to blame me if things go wrong and say, you made me pick a company. It's amazing how often people say, I can't think of a company. Come on, there are 47,000 publicly traded companies out there. You can't think of a single one? Say, can you give me a company? So for those of you who are struggling with the notion, I can't think of a company, I'll give you the advice, you're not going to like it. Go where it's darkest. Find a nice Ukrainian mining company to value.
Or Russian export import.
How about a Sri Lankan manufacturing company right now? You don't like the advice, right? But you see where I'm going. Those are the kinds of companies where people have given up. When people give up is when markets make their biggest mistakes. Pick a sector where people are just completely off balance right now. I think entertainment right now, people have no idea what's coming. They thought the Netflix model was going to win, but clearly it's not the winner that they thought it was. But the problem is, what does Disney look like now? A Netflix wannabe, right? Throwing the amount of money at Disney Plus that Netflix is. I think people are just completely off balance with entertainment companies. In 2009, think of how people were valuing banks. They'd given up. They said, we can't value banks anymore. They're not the creatures we thought they were. Those are your moments of maximum opportunity. But guess what? Those will also be the kinds of companies where you're going to say, there's an incredible amount of uncertainty. But think of it as an opportunity, not a threat, because that uncertainty is what's creating the mistakes. And all you can do is make your best estimates. You're going to be wrong a lot of the time. But hopefully at least you're trying and other people are not. Which brings me to a third and final misconception about valuation. If I make my model bigger, it's going to get better. And it's so easy to build big models now. I still tell people how I valued my first company. And I told my kids this. They said, Dad, you're ancient. I valued my first company in 1981. I know what the bonging there is. Hopefully it's not something bad happening. No? You know what I had to do to get the annual report for a company? I had to write to the company. Actually physically write, not type, write, because I don't know what process I wrote. Say, to the investment relations officer, could you please send me a copy of your annual report? I'd like to value your company. The company actually did the right thing. 2 weeks later in the mail, I get the annual report. When I described this to my younger son, he said, Dad, why don't you just go online and download the annual report? I said, 1981, online, I didn't even know what that meant. Maybe I'd have been in jail if I tried to be on a line. No. I got the annual report in the mail. And I valued my first company on a ledger sheet. You're all too young to even know what a ledger sheet looks like. It's just a blank sheet of paper with lines drawn through it. A pencil, very critical, not a pen. Never use a pen. Pencil and a calculator. You know why a pencil? Because every number has to be calculated and entered. And if you screw up, you've got to go erase numbers. And you write with a pen, God help you, you're going to be scratching out numbers. It's a complete mess. When you value companies on a ledger sheet with a pencil and a calculator, you know how many line items there will be in your valuation? As few as you can get away with, because every single line item has to be multiplied by the number of years, and you have to compute every single cell. There will never be 500 line items when you're doing things with a pencil and a calculator. Valuations were naturally shorter because people just couldn't do complex valuations. In contrast today with Excel spreadsheets, we've gone crazy. 2 summers ago, my youngest son was working at a hedge fund. As in, he was going to Yale, junior at Yale, summer he was working at a hedge fund. And he was asked to do a valuation. And he never calls me for advice, but he did that summer. And he said, Dad, I've been asked to value a company and I want your help. And I said, what would you like to do? He said, I'd like to do a 3-statement forecast. That's what they want me to do. You know what a 3-statement forecast is? What are the 3 statements? Income statement, balance sheet, statement of cash flows. His valuation, he had to forecast every single line item in an income statement, a balance sheet, and a statement of cash flows for the next 20 years. He said, how would I do it? I said, I would tell you if I knew. He said, but don't you teach valuation? I said, yes, but in 40 years of valuing companies, I've never once ever forecast out all 3 financial statements. He said, but don't you need some numbers from there? I said, I need about 6. Why would I forecast out the other 494? It's a distraction. It's one of the most least productive things you can do in valuation is forecasting things you will not need. But it's amazing how much time people spend forecasting things that they don't need and they have no information to forecast on. Less is more. It's called the principle of parsimony in the physical sciences. Bring it to valuation. If you can value something with 3 inputs, don't use 5. If you can value a company with 3 years of forecast, don't do 10. You say, what's the harm? 2 harms. First is, all those additional items you got to forecast, right? And that's a distraction from the items that matter. You're actually making your valuations less good by forecasting more stuff. This sounds completely, it doesn't make sense, but valuations that are more detailed actually sometimes yield valuations that are less qualitatively good than simpler valuations. So one of the things you're going to see me do is try to minimize my forecasting. Partly because I'm lazy and partly because I know what's going to happen if I add detail. Never add detail that you cannot bring something to the table with. So let's, with that lead in. Yeah, go ahead.
So does it mean that in our assignment we can just do a very simple valuation because simple is best?
Yeah. Well, it depends on what you mean by simple. If simple, you just put a cash flow that you take last year's cash flow and grow it. That's a simplicity that's like a surgeon saying, let me just put a big line, take my surgical knife, just draw a big cut all the way through you and remove all your organs while I'm doing it. So simplicity doesn't mean one line item. But it means that if you can value a company with a single line item, if you're a company with stable dividends growing at a constant rate, guess what? You can value the company with 3 inputs. A stable dividend paying company. But if I came to you with a company like Airbnb, you're not going to be able to do it. You have to add at least some layer of input estimation. But you have to ask, what's the least I can get away with when I value a company? Yes?
To your point about Apple and Microsoft and your love and hate for one and the other, isn't that true for other people? Aren't they doing the same thing? And so do they kind of even themselves out?
Well, I think when you say other people doing the same thing, what are we talking about? So let's say
others doing valuation. If someone else who's saying, hey, I think Microsoft is worth X,
right,
and you're saying it's worth Y,
right,
like they might have either the same beliefs.
They will have, not might, right? Everybody looking at the same company. All we agree on is last year's numbers.
Sorry.
Yeah.
I mean the personal biases. Doesn't everyone have that? And so does that just then kind of wash it?
Yeah, the
out?
overall market, it might get washed out unless you get the bias, because bias never completely averages in some periods, but that's what creates mood and momentum, right? So 2021, what is the bias on Zoom? Everybody thought that we were all going to be on Zoom for the rest of our lives. So the bias might have been to kind of overestimate cash flow, so the bias might have been more positive. So what happens is the overall bias in the market is never zero. It tilts back and forth. It goes around zero, but that's what causes stocks from being, go from being overvalued to undervalued. So at any point in time, there's always some bias built into the price because one side is winning over the other. So let's talk about the 3 ways you could put a number on a company. The first is what I'm going to call intrinsic valuation, where you value a company, value an asset based on its cash flows, its growth and risk. And we use discounted cash flow models as our way of doing this. The second is to price a company by looking at what other people are paying for similar assets. I gave you the example of real estate. You decide what to pay for a house by looking at what other people are paying for similar houses. Right? You decide what to pay for a company based on what other people are paying for similar companies. And there's a third approach that I'll talk about tangentially, especially tomorrow. There are some assets whose cash flows are contingent on something happening. Let me give you an example. Let's say you're valuing a young pharmaceutical company. How young? It's got no revenues, no earnings, but it's got a promising drug working its way through the pipeline. It's a blockbuster. A drug to treat diabetes, a vaccine for the next pandemic. What's a contingency here? If it gets approved, this could become a blockbuster drug, be worth billions. But if it's not approved, there's nothing left in the company. It's a contingent cash flow. Let's take a second example. Let's suppose that it's March of 2020. Oil prices are down to $35 a barrel. You're looking at Petrobras. Lots of reserves, but every barrel of oil in those reserves will cost you at least $50 to get out. But the price is 35, the cost of getting the oil out is 50, your reaction is, oil's worth nothing. It's under the ground, but it's too expensive to get. But there's a contingency, right? And the contingency is if oil prices climb above 50, these reserves could become valuable. You think, so what? When you have a contingent cash flow, as in the example of a pharmaceutical company, a natural resource company, you have an option. It's just a fancy word, but there are option pricing models that help you decide how much to pay for those reserves. So in March of 2020, if you'd said, are the reserves at Petrobras worth nothing? My answer would have been, not really, because there's some optionality here. Of course, 2 years later, you'd have seen the optionality actually pay out because oil price at 120, all of a sudden those reserves have gone from being non-viable to viable. Every single approach that puts numbers on companies has to fall into one of these three buckets. It's either an intrinsic valuation of pricing or some variation of an option pricing model. So before we take our break, at least let me set up the structure for doing intrinsic valuation. Intrinsic valuation, very simply, is one equation. The value of an asset is the present value of the expected cash flows on that asset. That's it. It's at first class we all get in finance, right? When you do the present. It's amazing how much evaluation is. In fact, the rest of the process is about coming up with better estimates of the expected cash flows and better estimates of the risk-adjusted discount rate. So if you think about what we're trying to do in intrinsic valuation, we're trying to estimate the intrinsic value of an asset. But it's a little bit like the search for the Holy Grail. You know how long people have been searching for the Holy Grail? I think Indiana Jones came really close, but I don't think even he found it. For thousands of years, people have been looking for the Holy Grail. They never find it, but they keep trying and trying. Intrinsic valuation is a little bit like that. Why? Because you never get to see intrinsic value. You just keep trying and trying and trying, even though you get it wrong every single time. You keep the faith. And if you break down intrinsic valuation models down, no matter how complex you make them, here's what you're going to see. You're going to see expected cash flows. You're going to see a life for the asset, and you're going to see a risk-adjusted discount rate for those cash flows. But ultimately, I said, I do valuation to make money on my valuation. So let's see what has to be true for you to actually be able to make money on your own valuations. First, you have to find market mistakes. Do markets make mistakes? I don't think you'll find a single person who disagrees with you that markets make. Everybody, even the firmest believer in efficient markets, will tell you markets make mistakes. But you have to assume that you can find those mistakes. And here's where you're on weak ground. And here's why. What's a history of people who try to find market mistakes? How successful are they? Or let me phrase the question differently. How much does the average active portfolio manager beat the market by every year? No matter what part of the world you're in.
0.
It'd be nice if it was 0. It's actually minus 1.5%. Last year, 88% of active portfolio managers in the US and 80% of active portfolio managers in emerging markets, S&P actually maintains this, did worse than an index. You think, but I can't make the index. Yes, you can. You put your money in an index fund, you're beating 80% of the people who try every day to go pick stocks. Strangest profession in the history of mankind, right? Can you think of any other profession we could get away with this? Let's try plumbing. If plumbing were run like active money management, here's what it would look like. I'd call myself Floods or Us. And you know what I'd do? You have a leak in your house, you call me and I leave a flood, and I insist you pay me. But let's say you're special. You can find market mistakes. You're not like that 80%, you're in the 20%. But the third thing you need to happen for you to make money is markets have to correct their mistakes. And that remains a mystery, right? First, there is no guarantee that markets correct the mistakes. With equities. With fixed income, there is a guarantee. If you have a market mistake in fixed income, there's a maturity date where that pricing mistake has to be corrected. With equities, you could have mistakes that last forever. And second, even when mistakes get corrected, we don't know what causes that correction. Which means you can be right and go bankrupt being right. But here's the consolation prize. The longer your time horizon, the greater the chance, assuming you were right in the first place, that you might get the correction happen. That is the secret ingredient into whether you should do valuation. If you have a long time horizon, you get a greater chance of markets correcting their mistakes. You can therefore go value companies and hope that the mistake gets corrected in your lifetime. Now do you see why portfolio managers can talk the talk, but they can't walk the walk? You know what the time horizon of a portfolio manager is? You're saying it depends on how long term he or she is. Not really. If you're a portfolio manager, your time horizon is only as long term as your shortest term client. Because they're going to be at your door saying, what have you done for me lately? If you don't have a long time horizon, don't even waste your time valuing companies. You're not giving the market enough time to correct its mistakes. So as I said, the basic theory is just one equation. And I stated the first proposition when we talked about ESG. It's the it proposition. If it does not affect the cash flows and it does not affect risk, it cannot affect value. You're saying, what's it? You name it. Brand name, great management, synergy, control, ESG. Right? If it does not affect the cash flows, it does not affect risk. It's a proposition I'm going to come back to over and over again in this class, because whenever you say, where is that? My job is to say, let's look at where we would put it in the cash flows of the risk. And the answer is, I can't find a place. You know what we should do? Take it off the table. It's not worth wasting your time on something that really doesn't affect the cash flows and doesn't affect risk. My second proposition is a very simple follow-up proposition. You sit down to value a company. You come up with negative cash flows for next year. Don't give up. Do year two, still negative, still negative. It's a company whose business model is so broken you cannot figure out a way for its cash flows to turn positive. Your cash flows are negative for as far as the eye can see. You know how much you should pay for that company? Don't think too long, because this is what gets you into trouble. You have a company which has negative cash flows forever. They should be paying you, not you paying them. I don't care what's on their books and what the replacement cost of their assets is. If you have negative cash flows in perpetuity, this company is worth worse than nothing. You need to get paid to take this company. I have valued companies with broken business models where I cannot figure out a way to get the cash flows positive because the business model is so fundamentally broken that I can't fix it. But let's take a more hopeful case. Your company project cash flows in year one, they're negative. Year two, still negative. Year three, negative. But they're getting less negative over time. Why? Because you're getting economies of scale as the company's getting bigger. The unit economics are helping you. The cash flows eventually turn positive. That company could still be a very valuable company if you get disproportionately large positive cash flows in the future to make up for your negative cash flows up front. You see why those cash flows have to be disproportionately positive? If you lose $1 billion in year one, you've got to make $10 billion in year 10 to make up for that billion in year one. So what type of companies do you think have negative cash flows up front? Years one, years two, years three. But I'm sorry, what?
I think technology companies.
Microsoft is a technology company. It's got large positive cash flows.
But not necessarily when it started.
Let's make it young companies. A young infrastructure company, a young technology company, a young manufacturing company. What's the young got to do with it? If you're a young company, your business model is still getting formed, right? You're probably going to lose money for a while. And if you're a young company, all your future comes from growth that you expect year 5, year 6. And to get that growth, what do you have to do? You got to reinvest in R&D if you're a tech company, in building toll roads if you're an infrastructure company, in building a plant if you're a manufacturing company. You got to live through the pain to see the gain. you're going to see me value young companies, and guess what you're going to see as cash flows in years 1, 2, 3, 4. If I tell you it's a young growth company, you should expect to see negative cash flows up front. It's called cash burn. And people often wring their hands about how terrible it is that this company is cash burning. If it's a young growth company, that's exactly what you should expect to see. So with that lead in, let me set up the structure we're going to use to think about valuation. I come to you with a business and I say, value me. You have a choice to make. There are two ways you can put a value on my business. The first is you can value just the equity in my business, my share of the business, my equity in the business. The second is you can value the whole business. Sounds like I'm playing with words, but let's think about the contrast. Let's say I've started a business and you guys are going to be equity investors, you guys are lenders. I raise equity from you. I borrow money from you. I start the business. I start running the business. It starts generating cash flows. Who gets first claim on the cash flows? Lenders, with interest and principal payments. And if there is any cash flow left over, you might get them as dividends or buybacks, or I might just hold the cash for you. What I'm trying to say is when I'm a business, I generate cash flows for both lenders and equity investors. The equity investor cash flow is a residual cash flow. If you're valuing equity, here's what you do. You focus on just that residual cash flow, the cash flow left over after debt payments, and you discount them back at a rate of return you would need to make as an equity investor. Let's not use any theory or models. Just intuitively, when you're investing in the equity in a business, you need to make a rate of return. That rate of return should reflect how risky the equity is. Let's call it cost of equity generically. You look at cash flows to equity, you discount them at the cost of equity. You get a value of equity in the business. Now, if this were a publicly traded company, what's the only cash flow you actually see which is tangible from the company as an equity investor? What's the only cash flow you? Dividend. Everything else is, I can compute a cash flow to equity. The dividend discount model is a special case of an equity valuation model. It's a special case because I'm using dividends as a measure of cash flow to equity and discounting. You're saying, so what? Well, it assumes that companies pay out what they can afford to as dividends, right? And we know that's not true. We know beyond any, there's absolute proof in every company's balance sheet that the company doesn't pay out what it can afford to in dividends. Let's say I'm the Google CFO. I get up here and say, I pay out, we can't really afford to pay dividends. What gives me away that I'm lying? The $120 billion cash balance, right? Because when you don't pay out what you can afford to, I'm not saying this is good or bad. I'm just saying when we use dividends, we're using the portion of the cash flows that get returned. But if a company doesn't return what it can afford to, I'm going to undervalue the company. So we're going to talk about estimating potential dividends. It's called free cash or equity, just a fancy sounding word for this is how much the company could have paid in dividends. But that's an equity valuation approach to the world. But there's another way I could approach valuation. Remember, lenders supplied capital and got cash flows from the firm as well. We don't think of lenders as partners, but they really are partners in this process, right? Think of the collective cash flows that both of you got from this business. You got cash flows to equity, whatever's left over. You got interest, principal payments. That collective cash flow is called the free cash flow to the firm. It's a pre-debt cash flow. And if that's the cash flow I'm discounting, I'm no longer going to use the cost of equity, which is what you guys wanted. I'm going to use a weighted average of what you wanted, which is the cost of equity, and what you wanted, which is the cost of debt. And what's that weighted average called in corporate finance? It's called the cost of capital. Cash flows to the firm discounted at the cost of capital gives me the value of the entire business. You got to make your mind up early as to which way you're going to go, which road you're going to take, because every single input you're going to estimate in valuation is going to be determined by which road you chose. Let's play it out. You guys are going to value equity. You guys are going to value the business. I'm going to come up with each of the big inputs in valuation, and let's think about how you're going to approach it differently. So the first question I'm going to ask you is, what were your cash flows last year? So if I ask you that and you're equity focused, the cash flows you're going to give me are cash flows after taxes, after debt payments. It's the cash left in the till after everybody else has been paid. Whereas if you're valuing the entire business, the cash flows, you need to be estimating cash flows before debt payments, before interest payments, before principal payments. So even the cash flow measures are going to be very different, especially if the company has a lot of debt. Second question I'm going to ask you is, how quickly are your earnings growing? If I ask you that as equity investors, what are the earnings that equity investors get? Net income, earnings per share. The growth you're going to give me is growth in net income or earnings per share. But when I ask you that question, as a business, remember as a business, your measure of income is operating income. It's income before interest expenses. The growth rate you'd give me is growth rate in operating income. You think, what's the big deal? They're all earnings. Guess what? As you go down the income statement, growth rates will tend to get higher. If you have a 3% growth in revenues, it will turn into a 5% growth in operating income, an 8% growth in net income, and a 10% growth in earnings per share. So even the way we think about growth has to be different. Then I'm going to ask you, what's your discount rate going to be? When I ask you that as equity investors, the discount rate you're going to give me is a cost of equity, because that's all you care about. When I ask you the same question, you're going to give me a cost of overall capital that reflects the risk of the overall business, not just the equity in the business. And then I'm going to ask you a final question, and we'll make this a final question before the break. I'll ask you, when will your company become a mature company? Your first reaction is, what the heck is a mature company, right? You know what a mature company is? Is one that grows at a rate less than or equal to the growth rate of the economy in which you operate. You're saying, why do you need to know? I have a math problem, and let me show you what it is. See this equation? The value of an asset is the present value of the expected cash flows over its lifetime. So if I give you a 10-year asset, you estimate cash flows for the next 10 years, you discount them back to today, come up with a value, right? Let's say you sit down to value a publicly traded company. What's the life of a publicly traded company? You look at a corporate charter, it tells you when the company was founded, right? When does it say the company is going to be wound up? It doesn't specify a date. At least in theory, the company can keep going and going and going and going forever. So let me get this straight. To value a publicly traded company, then, I've got to be able to estimate cash flows forever. It's like an Excel spreadsheet that never ends, right? That's basically what forever looks like. Who wants to do that? Who can do that? So you know what the refrain in valuation is? Can I stop now? How about right now? And I'm going to give you an answer as to when you can stop, but you're not going to like it. You can stop if you're willing to make an assumption. You know what the assumption has to be? That beyond that point in time, your cash flows will grow at a constant rate forever. Let me repeat that again. That beyond that point in time, your cash flows will grow at a constant rate forever. You know what that buys you? It buys you an infinite series in mathematics. The G is constant, the R is constant, it keeps growing. And 200 years ago, mathematicians solved for the value of that infinite series. We stole it in finance. We act like we invented it. But it's this equation you will see at the end of every intrinsic valuation where it's called a terminal value. Basically an equation where your growth rate is constant forever. And this equation captures the present value of your cash flows in perpetuity. But to make that assumption that your cash flows will grow at a constant rate forever, I also have to accept the fact that that growth rate is constrained. By what? By the growth rate of the economy. And here's why. You cannot have a company grow at a rate faster than the economy forever. Please don't ask me why. Just check it out in your Excel spreadsheet. Take two numbers, one big, one small. Let one grow at 7%, the other grow at 3%. Keep the numbers going. Tell me what happens eventually. You know what's going to happen, right? Your company is going to become the economy. Then what? Or globalization. Keep going. It'll be part of, then you'll be the global economy. Then what? Now do you see why I asked you, when will your company be a mature company? Because if you can tell me your company is growing at a rate less than or equal to the economy, I can put closure. Now when will that happen for your company? It depends on the company, right? When will ExxonMobil be a mature company? It actually was 15 years ago, right? Now it's beyond mature. What comes beyond mature? Things you don't want to see but happen anyway. When will Toyota be a mature company? It probably already is. When will Facebook be a mature company? Maybe in 3 or 5 years, but 3 years ago, that might have been 10, 15, 20 years. When will Netflix be a mature company? You can see that the answer to this question will not only vary across companies, but will also vary across time for the same company as things happen to the company. So when we get back from the break, what we're going to do is actually go through a few big picture valuations, where you're going to see me value entire companies. And as you see the valuations, you're going to say, where did that number come from? Hold off on that, because this afternoon we're going to spend on the numbers, on the inputs that drive these valuations. So we're supposed to be back at 11:15. So
11. Sorry, we'll have a
11?
shorter break.
11.
Yeah, so it'll be around 11 that we're back.
So is it supposed to be